Greetings, market rebels, chart watchers. Welcome to this week's macro measure. I'm Wayne. My partner Ryan is currently working on wrapping up our market outlook for the upcoming week. It is October 9th, 2022, a little in front of 2 p.m. here on the East Coast. And I'm going to flash the necessary disclaimers and so on and so forth, and then we'll move into things. So here's a quick look at our disclaimer, and then here's a quick look at our intellectual property rights notice. I think that should just about do it on those. And I hope I could remember everything that I'd like to discuss this week, but always try to do my best on that. I'm starting out, as you can see, with just a quick sector look, just to note that XLE, which really had a tremendous week, that pulled back a little bit there after putting in a new high for the week on Friday. But aside from that, you can see that all the other sectors that I've got on here on this grid, they all really rolled over, right, from the highs set earlier in the week. And some, of course, fared worse than others, worse than others. But the point is that they were all in some rough territory by the end of the week, the way they acted on Friday. And I think what we were talking about last week, my recollection is that we thought, oh, you know what? Energy looked pretty good. It was one of the things we thought, I think, looked better. And it really exploded more than I would have expected, frankly, given the kind of market that we have. But I guess the news and energy was really what drove that. But that turned out to be interesting. The UOA that I mentioned in there turned out to be interesting as well. So that was nice. And the XAU, which I'm not showing right now, but XAU also turned out to be a pretty good one. It actually did something for a change. In other words, aside from go down, let's just take a quick look at that. But that was interesting because that was a great example, I think, of where when you take a look at these charts as we do week in, week out, keep your eyes on them, you can see that certain things are looking good, certain things aren't looking so good. And the metals looked interesting, and they had some paper, and that did pay off. So they had a good follow through on, I guess, Monday, then into Tuesday, held in there really until succumbing on Friday. So that was nice. But overall, really, right, we can just say that even though we're talking macro measure here, I will talk about more of this sector situation. But other than that, right, semis, which is something else we'll note in sector situation, they tried but failed. And of course, we had XHB we like to look at, just kind of for the record to round things out here. But yes, I mean, everything rolled over by the end of the week. And so where that brings us to is a risk off moment, right? We had really, the market went back into risk off by the end of the week, you could say on Friday for sure. Now, what I want to look at is a little bit different this week, because I'm looking at some bigger picture stuff right now. And I mentioned this on Cocktail Hour. The way I'm looking at things, I'm looking at them more of a weekly view at this point. And hopefully that'll become clear why I'm doing that. But one of the main things, which I think I did mention on Cocktail Hour, was that this purple line, as many of you already know, is the 200. And on the weekly, that would be the 200 weekly, right? SMA. And so you could see that the SPY is really right back there again. And last week's candle was just very disappointing and ugly by the end, right? So that looks very concerning. I think most people would consider that concerning going out. The Bollinger Bands are down here, and I don't alter the settings on the weekly or anything. So those are just based off of this 100 period moving average here and set to plus and minus 2 standard deviations. So that's where they are as well. And I just wanted to note that the way that we're tracing things out, and it looks like this line may have moved a little bit on me. That should have been, I think, a little bit more closer to there. But the way that things are getting traced out here, this is a pretty big deal if it loses this 200 week. And a lot of the indices, the major index ETFs or the indices that they represent are at a similar juncture, which we'll see. So that's telling you, right, that this is really, I think this is getting close to this phase here. I think I mentioned that really without dramatic news that would shift things, I just don't see how we don't get some kind of a washout. I don't know if you'll get this level of washout. I would probably say you won't, more than likely, because that's really one hell of a month and a half right there. or a month or so. Not so sure we're going to get 4 more weeks of something along those lines. But again, you never know. But I would think, look, if you go back and look at where the big time support should be, it really should be somewhere right around where our Bollinger Bands are. So let's just ballpark it at 350. Now there should be support there. What does that mean for position managers? Well, if we do get a drop, and we did put a bunch of bearish ideas in the services, of course, and there's bearish verticals in the major index ETFs. I think I at least got ones on in the SPYs and IWM and the Qs, or at least 2 out of those 3. But I look at too many symbols to remember everything all week long. But bottom line is 350, right? At that point, you get a nice ride lower. If it does transpire that way, that's about 3% roughly. And so you've got to do some rolling at that point. Even if you're in a vertical, roll the in the money put down, or let's put it this way, the higher strike at the very least. But if you break there, right, and you start to extrapolate, then it starts to get far uglier naturally. I would think there's probably going to be some support. I think you can see sort of flat line of support here at probably even up in here at 335. There's some right around there, 330. There's a couple different levels that it would respect on the way down, but it would really be very oversold at that point. So let me just bring up another view for us, try to give you a sense of where we would be. And this is something I don't really show very often, but this is just showing where major moving averages are, the price in relation to those. And so the price in relation to the 200 period moving average is the red, and so on. And then the white one, the white is, I think, you've got, it should be color code. I'm not sure why it's different than that, but it is different than that for some reason. Yeah, I thought I had that all set up as the same color. Well, regardless, right? The point of this isn't going to change the general point here. I'll have to go back and try to fix that. But if I mouse over this one, let's see what it says. It's handling them all the same way. But the reason I'm bringing this up on the weekly is just to show you where we are, right? That's always the question I'm asking. Where am I? I'm trying to figure out what market environment I am within the context of that market environment. Where am I currently? And you're really at some extreme lows already. So if we go back even further in time, there's 10 years on a weekly look. You can see that to be this much further below your moving averages, it doesn't happen, right? This is really in the last 10 years, we're either at the second or third worst juncture. The only time that was really worse than this was over the course of the last 10 years is back here during the COVID sell-off. So this is really already into some pretty rough stuff. Now, remember that the seasonality is theoretically supposed to kick in this week, really. You should start to see some kind of positive ebb to the market, positive flow to the market, whatever you want to call it, because that's the seasonality call, of course, which is never a guarantee, but that's the general idea that you're going to follow that. But of course, then there's analogs that say we still have a ways to go right now versus how stocks have performed in prior years, and tracing out similar patterns to what we've seen in years prior that has similar characteristics associated with them. For example, the 2008 analog, because we're seemingly we're in big trouble and potentially in housing and with rates and debt and so on and so forth, and things became overextended. But putting it all together, I think you could see that on the SPY, on this view, 350 would be a level that I think makes sense. And then we could start to find others from there. But if we were honest about it, I think roughly like in the lower 340s, there's probably something. We can keep going down. You're going to just see flat lines up here and here in the mid 330s. Depends on where you want to mark it. But if we do it based off of projections and so on and so forth, and you want to believe that we're going to trace out in some sort of like a throw over to the Bollinger Bands or a real washout, you could see that probably if you were to do that very quickly and maybe just within like 2 to 3 weeks, that would probably make sense to come down to about 320 on the SPY. And that's a pretty good drop. I mean, that's what would that be? Another maybe like another 11%, rough 10 to 11% from where we are. And it's been a rough year so far. So if you were to get something like that and everything kind of dovetails where flatline support would come in with this particular, I guess you call it expanding wedge type of a pattern. Some people are going to give it the old megaphone call, whatever you prefer. These are all just terms people have made up. That there's really nothing set in stone with those as far as I'm concerned. But remember, this is probably means that you get the washout, right? To be able to do that, it means that all hell has to break loose, and to prevent it, right, there probably has to be the absence of things worsening in terms of data and news. And the data and news just hasn't been supportive, and that's very common with trends. It all kind of makes sense, right? That during a very strong bull market, the news tends to be on the positive side, just a better positive vibe out there around the world. And then when you're in this kind of a situation, you're really struggling. But this is very similar across everything. So let's just jump over to the Qs, and then we'll go to the diamonds and IWM. But you'll see it will look very similar but different. Right now, it's the same thing down here. We're still looking at 10 years of weekly, and you're at some of the very worst levels. So to really get blasted from here, which again, I don't think you can rule out. I think it might be we might need to be able to get that, which I'll talk a little bit about. You're at a big level, I think, here on the weekly, and there's not anything really close by around here. So it's hard to say with the nature of the market being that it ran through here fairly quickly. I think the next level, probably somewhere around there at 260, would be it just happens to be a round number, and probably somewhere near these highs, and maybe that open and that close right there, which is the mid 255 area. So if it just keeps going from there, I don't know. We'd have to start working into, again, larger patterns, other fibs, so on and so forth. It might not hurt us to do that at this point, just to put a fib on here. And I'll just say this is the COVID low. We'll come up to the post-COVID hyper madness of central banks and the federal government, which was just, I think anybody that was still prudent during those times was a rare person indeed, because it seemed like everybody was cheering for that kind of madness. But that gives you an idea. And interestingly enough, the 61.8% retracement does come up into the mid 250 range on this whole move. So maybe, right, that does make sense, 255 to 257, but 260 is the number first before that. We could then start talking about here. I think after that, you're looking, another, let's be realistic and say you get through 250, you're looking at the high 230s, I think would be your next spot. But you have to do this from a really beaten down level. And let's just diverge and come back to round things out. I want to get a quick look at this here. And this is what I wanted to show, that the fear and greed index, which is not a perfect calculation by any means, but right now it's registered 22 in the extreme fear zone or category. But if you look at it where it's been over time, this thing has certainly, even this year, been more extreme. So we're not there yet. And that's what I mean. You're not getting that capitulation. You're not getting that VIX to pick back up on that. You're not getting that VIX into the mid 40s, like on a really ugly kind of like cascade selling, washout phase, capitulatory phase, whatever you want to call it. You're not getting that. And even some of the things I've shown here and there lately, let's take a look at the number of stocks, right, that are above their 20-day moving average. With what they did early last week, this really improved a lot. And now it's not really into the super low area. So that has room to potentially go back down. Let's do MMFI. MMFI would be the 50. And so MMFI, right, it's similar. You're not really there in terms of lowest readings that we typically see. And remember, these did do a fairly good job of correlating with the tradable lows that we've seen this year. And then finally, I meant to do TH, it should be above 200. And you can see The same thing here with the 200-day. So this is well off the lows. Now, it wouldn't take much, I don't think, to get back there. Another couple of ugly days and probably you're there. But you're still not really, let's say, toasted yet, a word that was popular a long time ago. But yeah, so this is not extreme. The VIX, let's go back to our charts. We'll take a little quick divergence there because the VIX is not extreme, and then we'll come back and round things out. But the VIX is certainly right. It's hanging in there. It's elevated, but it hasn't done. This is kind of what I'm getting at, right? That's a high 30 spike there. I think that's a high 30 spike there. This one gets you into 41. This one gets you up to 44. Here you have 47. Something like that would sort of really give us a better signal that there's a tradable low, and maybe that would last longer than just a few weeks, maybe six, more than just a few weeks. Maybe we would at least get months out of that. Now, we did see some call activity in the VIX that I put out for subscribers, and that's starting to tick up. And we were joking that it might be 50 ratio because there was a ratio spread that was huge and far out of the money's the way out in time. But there was another big hit recently as well by 50 cent or 50 ratio potentially, because it sort of had those characteristics that 50 cent likes to have, whoever that trader is. But they've nailed some pretty good stuff, so we do pay attention to it. Now, let's take a look at IWM. This one's been really interesting. This one, to me, it's already, you can see that this is different in that it's already below the purple 200 week, and you're outside of the Bollinger Bands again. You had an ugly candle. It's I think it's right at where you broke down from, which I always like to note because I think these levels to me are these big break up or down levels are big, and it kind of shows you here that it's again a big level because it gets through there and goes big. So for some reason I've just always noticed that stocks will often return to or respect levels where they broke down from, and I would say that's about where you broke down from or broke through to really create this tremendous run that it had. But now, you're right back on the Bollinger. We know that you're stretched. Your RSI reading, just to throw that out there, is 40. So that's part of the issue, is that the weekly RSIs, which I didn't want to fail to mention, weekly RSIs are not in the high 20s or something like that. They're getting towards 30, but they're not there yet. So on that measure, right, and just like looking at where support could be here, if we were to fall fast, this could really, again, have a washout. So I don't want to sound too really apocalyptic. Let's get the diamonds in here. I just don't see at this point, without news, how this thing is going to turn around. I don't know what they could possibly use and try it out to justify how, really, with the world economy just sort of circling the drain and so on and so forth, how that magically turns into this great opportunity that it creates a massive run. Now, I know the short squeeze can kick in. Of course, all of us know that towards the end of the year, they could try to manufacture something, but I don't know how far you get in the face of all these issues, right? With high inflation, with interest rates high, relatively speaking, and heading up, the energy issues all over the place, right? The slowdown that's happening really in so many places, and even here, but hasn't evidenced itself in a lot of reports quite yet in the United States. But anyway, 37-ish if we round it off in the RSI on the weekly. So diamonds, right? They're out of the Bollinger Bands. They're already below the 200, as we've been saying. So we would look to levels, and of course Ryan will put levels in this week for all these things. But that's the thing. Like, at this point, to really break down hard from here, you have to call that, I think, at least the start of a washout phase, because you're already close to oversold. Your market you're stretched to the downside. You're below some key areas. You're not quite at 30 if you want to be a stickler on that for RSI. Spiders, let's see where the RSI is on that one. Currently, it is at 37. And then of course, yeah, this is just correlations, just kind of all going towards the market, as they often do when there's panic in the air. And this one's at 36 if we round it off, but it too, the Qs are below the 200 week. They're just right near or on the year Bollinger Bands. So there you have it. I mean, what happens next is we already talked a little bit about where it could find some support, bigger ones, but I just don't see what's going to help this. It would take some kind of a news story, and then you would sort of have the makings of a slight false breakdown in the case of, I think, the IWM and the Qs, but more, I'm sorry, in the Qs and the diamonds, I meant, but in the spiders, it would kind of be more of a, I think the spiders might show a little bit more of a double bottom. They're still below, but they're below by not so much. IWM, I'm looking really to gauge, are the lows at the same level or very close, just kind of visually. IWM would give you more of a double bottom if it somehow were to reverse from here. But I think that you're on the verge. I think you almost have to have the washout to get something cathartic that starts to help at least heal for a little while, because to keep doing this would be, well, you could keep doing this, but this would be really torturous to keep having these very brief 2-day affairs at most, and then you just keep rolling over and rolling over and rolling over. Might eventually be worse if that were to happen that way. So just remember seasonality kicking in. So this is getting very interesting, but I would say, look, if I felt that the news cycle was about to help out, I would probably say, well, this is, keep your eyes out for rally attempts, because seasonality is coming up. Market mostly bombed out. We've seen it worse, but it's not terrible. So you might have a little bit of kind of healing on this kind of cluster low we're seeing in the major index ETFs versus this, that things may be a little bit better. But the way things closed out and how we went to risk off again quickly, and the fact that this is not, we've not seen that massive VIX spike to this point, and maybe we will, but that tells me, right, that it's still not over in the traditional sense. It could be over and we're just looking for things that will never appear. They appear most of the time, but maybe there's reasons this time they won't, and we'll be waiting, much like Linus and the Great Pumpkin never shows. But I don't think that is looking that way. I think if you look at the DXY, which we've been making a case for folks to keep their eye on this all year long, the dollar, I think it might be better to show this one on daily, but the dollar recovered. We had these levels drawn. We discussed these during the week. I'm not sure if it was UOA Pro or if it was Rebel Pit, but may have been both for all I remember. But these levels I had marked out, and this closed strongly. So I'm thinking, the red is your upper Bollinger Band. But if this thing is going to be interesting, because if this goes up here, then we have to see if we're having a retest. Now, what bulls in the stock market would probably like to see would be that this thing struggles, can't push up any further, and then rolls over with a lower high put in, with a lower high. And then we see if we get more breakdown. But as of right now, the dollar closed out the week strongly, and it's still in an uptrend, as you can see. And then the same thing happened with the 10-year yield, represented by TNX. That also closed out strongly and is working its way back up as well. So that was rough stuff right there. That did not help the market, in my opinion, the second half of the week. So here's your final look at the VIX. I don't want to belabor all this stuff, but there you go. There's a look at the VIX there and how that closed. And I think honestly think this is subdued. I'm really not sure with all the rumors flying around out there exactly why this is what it is, but it just may be that everyone's already bought more hedging, done more hedging, I should say, than they typically do. And so there isn't as much panic. It could be that. It's a very hard thing to gauge if you're not spending a lot of time and you've got access to a lot of data and some real statistical wizards. It's really tough to put all that together to say, oh, I know exactly why the VIX isn't spiking the way you would think it would, but it's been subdued more than I think a lot of us have grown accustomed to. So it is what it is. So if everyone's always likes to hear more of a call. I try to talk about what I think is the most likely scenario, but getting some feedback on that. People want me to make calls. I think I think it's counterproductive to do that and get your ego invested in what you just said, because I think you'll be less likely to be flexible and nimble when the time comes. Just to go on the record for that, but I'm looking at it like I'm almost thinking like without some kind of dramatic news that really shifts things, this should be the start of new lows, a breakdown, and a little bit of real panic, so that we can maybe get more of a low, at least it's sort of like this one here that led to right mid-June until mid-August. So we got a couple months there of better action. I'm thinking you need to have something that looks a little bit more ugly, kind of like we got there, which would give us something like, as we've been noting, down to here, something like that, down to 340-ish. And then you get down there, you're really, really outside of your Bollinger Bands like you were there. Some big volume goes up like it did in front of that kind of a thing. And the VIX spikes. And then, maybe then, right, without any more bad news appearing, stocks have been sufficiently discounted and with a punctuation mark at the very end of it. And then we see some buyers that want to position themselves because there's still a bunch of true believers out there. They think there's value. They step in, they start buying. People notice that, they start buying. The squeeze ensues, and then you at least see some nice bull side action that we can hopefully trade back to the upside. But I am not a short-term. I'm not a short-term bull in the sense that I think all these problems are going away. I'm not an intermediate-term bull for the same reason, and I'm not a long-term bull. What I mean by long-term is I don't think that in the next, say, 1 year that everything is completely over and done. Now, the market may be on its way back up, but I don't think that the fallout from all the ugliness that we are seeing in the United States and abroad is going to have fully played out at that point. I hope to be dead wrong. I hate to always have that opinion, I guess, at the right times, just because it means pain for people, but unfortunately, having gone through a lot of these major sell-offs, that's where I think we are. I think people are a little too eager still. There hasn't been enough psychological damage, and the buy the dip gang hasn't been routed enough to really say that you have this final bottom and that it's really time to go. Maybe we won't get that, but typically that's what's really ended the really ugly phases that people just don't even want to talk about stocks, look at stocks, anything like that. That is what has really ended the monstrous bears that I've traded through. So on that note, I think I'm going to wrap up. I hope you got something that was worth your time, one little nugget that maybe helps you out this week or going forward. And as always, thanks for tuning in. I'll see you through updates, webinars, and cocktail hour and other things throughout the week. Thank you.